Hello and welcome. You're watching a very special edition of Commodity First right here on ET Now. I'm Ajay Sharma. This edition is focused on the OPEC meet, which is scheduled for tomorrow. But looking at the commentary coming in from large players, there are already some amount of movement in crude oil prices. In fact, volatility is the new normal as far as oil markets go, and it has remained so past several months now. The 12-membered OPEC, as you know, is set to meet tomorrow in Vienna, hoping to arrive at some consensus on fixing a level for production. OPEC, remember, accounts for a third of the global oil production, and in September, OPEC kind of agreed to cap output at almost 33 million barrels a day. They had broadly outlined versus the current production levels of close to 34 million barrels a day. Tomorrow's meeting was expected to be a rubber stamp to that broad agreement which was agreed upon in September. But closer to the meeting, we have seen that there is no consensus till now over production levels within the OPEC itself. OPEC's top producer, Saudi Arabia, has said that markets would rebalance on its own and hence no need for production cap, while other non-OPEC but strategically very important players like Russia has decided to give tomorrow's meeting a miss. This news came just about an hour back and actually impacted crude oil prices, which started coming down in the last hour and a half. Meanwhile, Algeria and Venezuela oil ministers currently are in Moscow in the last 2 days in a final attempt to persuade Russia to participate in this talk. Russia has also insisted that the meeting should be postponed to some other later date. So, what about the other member nations? Iraq has expressed reservations over a production cap, while Iran is keen to hold output at current levels. Will there be an agreement, or that's the theme of that will actually the theme of today's discussion? We have a power-packed lineup for you for a 360-degree analysis on that, on the broader macro front, on the trading front. What would be the repercussions? Let's get you our guests then. Shah of Geojit Comtrade will tell you an India perspective. Old Hansen from Saxo Bank and Vandana from Vanda Insights are also here for an overseas view. Also joining us over the phone line will be Abhishek Deshpande of Natixis from London, and Hans van Cleef of ABN AMRO Bank will be joining us from Netherlands. People, good evening. Thanks a lot for your time. Mr. Hansen, let's start with you. There has been a kind of a turn in prices the last hour and a half on Russia's commentary. How do you read this now that we are going almost hours away from the actual meet?
Well, I think it's clearly once again showing that these negotiations will go straight to the wire. The market is still battling, or the different parties are still battling for positioning, and it has obviously left the market quite nervous about whether a result will be made. I think at this stage, I think from an economic perspective, I think they cannot afford not to reach the deal, and that's really my. Even though we're seeing the market risk or chances fading a bit here, I think the economic side of it is still the main reason why we will strike a deal of some sort tomorrow.
Right, Abhishek, there in London, how's the movement, and also your observation? What are the talk you are gathering from? Okay, let's talk to Vandana meanwhile before we get to Abhishek. There is some sketchy line there. Vandana, what's the importance? You have been sharing some of your views on the Twitter going into this meeting. Just now ahead of the meeting, what are your thoughts?
Hi, good evening, Ajay. It has been very exciting, quite a roller coaster ride for prices, and looks like that's how it's going to be, right? And going into the plenary ministerial session that's due tomorrow. In some ways, I'm not entirely surprised because you recapped quite well a while ago that yes, there is a broad agreement. There is a very strong desire. I think we can say that safely since the Algiers meeting amongst the OPEC ministers that something needs to be done, that what the decision they took in 2014 was probably not the right one. I think where it has all gotten stuck is that they want OPEC to cut, they want supplies to reduce, but every country is being a little bit nationalistic. It's like Iran, Iraq, and Nigeria and Libya, understandably, but I think Iran and Iraq have become major sticking points. They're saying, basically, let somebody else cut, let the Saudis cut, let the Russians cut. These are much bigger producers. They haven't faced the troubles that we have faced in the past few years, whether it's from insurgents or it's from nuclear sanctions. So why should we cut? And I think that has now become a huge stumbling block.
Abhishek is here from London. Abhishek, as Vandana was talking about that it's all the matter has become nationalistic versus economic related. What are your thoughts? How do you see this importance of this meet? Do you think there are chances, and how much chances would you assign at progress to be made tomorrow?
I think they are definitely going through very tough negotiations here. Both parties or both sides of the countries, which are both either have suffered through sanctions or through war-related shutdown of their production or slowdown in their production, versus some countries like Saudi Arabia, who has actually had increased their production and their finances in the past were better, excluding the last 2 years. Of course, they're going through a tough negotiation. Both of them are trying to push for whatever they can get best out of this. Saudi Arabia, of course, wants to cut, and this they have very clearly identified since Algiers. But I think how much they want to compromise is questionable. I don't think they're ready to swallow yet that additional 200, 300,000 barrels per day gap, which seems to be in the market right now in terms of negotiation, not actually in surplus. But the negotiation gap right now is 200, 300. Who is going to bridge that? And Saudi Arabia is not probably yet ready to gulp that extra 200, 300. And Iran, Iraq, rightly so, want someone else to take, or larger or stronger players to take that extra cut, because they have a reason behind their production to rise is because of the past sanctions. So I think the negotiations will be tough. They will continue until the last date. And the chances still are 50-50 for an OPEC to reach an agreement. But at the same time, remember, it's just a matter of another 3 to 4 months before markets will be balanced anyway. So no country, such as Saudi Arabia for that matter, may be ready to take that extra 200, 300 cut by then, in addition to what they're agreeing to, just to satisfy the other party at this point.
Right, fair point, Abhishek. Hans Van Cleef of ABN AMRO is also with us. Hans, Abhishek was making a point that in a couple of months, the natural demand supply equation will already balance out the market. So probability of any agreement is weak tomorrow. Talk to us about it, what you make of it at ABN AMRO, and also the almost a U-turn by Russia ahead of the meeting. All this while last couple of weeks they were kind of giving an indication that they would come on the negotiating table. But now they say they're not sending any representative to Vienna.
Yes, indeed. I agree with the fact that the oil market is heading towards a balance between supply and demand anyway. So that's something that's fully true. But it also increases the possibility of an agreement tomorrow. Simply because, at some point, we heard a lot of noise and a lot of words about this deal, and at some point OPEC must deliver as well, especially from Saudi Arabia point of view. They want to show that OPEC is still in control, especially the new oil minister. So I think there's a good chance that there will be some sort of agreement. But I must also say that there's a big possibility that the markets may be disappointed anyway. After all, if the production cut is not big enough, the markets might be disappointed, and we of course have to see whether OPEC countries will actually deliver. To comment on your Russia question. We see that the pressure today on prices because Russia indicated that it will not attend the OPEC meeting. Well, as we all know, Russia is not an OPEC member, and therefore it never joins such a meeting. So that's on its own, it's not very strange. And of course, Russia indicated that it's willing to freeze production growth. But I don't find that very exciting as well, because Russia increased production very fast in the past few months, and it might be reaching the upper limits of a production capacity anyway without new investment. So, and knowing that Russia also would benefit from higher oil prices, it's very normal that Russia indicates that it's willing to freeze, but I think it's no surprise that it will not join the OPEC meeting.
Right. Mr. Hansen, in your view, what would be the swing factors? All our panelists so far have brought a lot of points on the table, But in your view, what would be the crucial factors to watch out for? And also share with us what are your own estimates for prices, say a couple of months far out, despite of how the meetings pan out?
Well, I think to take the last question first, the next 40 hours, I think, is really going to determine whether 2017 will start from a price close to 50 or closer to 40. That is really because there is a lot of pent-up investment interest on both sides of the equation. So one obviously has to give, depending on the outcome. And I think also, as both Hansen and Abhishek mentioned, it is really clear that going out and not agreeing to a deal at this stage, where we literally just months away from the market balancing, not getting a deal at this stage will obviously prolong that process. So if it's a question of having to cut your production or freeze your production for 3 to 6 months and then get a price of $5 to $10 higher, then that's obviously a deal worth taking, I think, for everyone. But again, politics may get in the way, and that's really the key to look out for. So the question really remains, if OPEC or if Iran agrees to a freeze, again, you can discuss what level it is. Is it the Iran's level, or is it the secondary estimates for their production? But if they do agree to a freeze, whether Saudi Arabia will accept that in the short term, knowing that will help the deal along, and thereby also creating the price stability and potential for a slightly higher price than what we're seeing right now.
Well, let's get you in as well for a trading perspective. Suppose a trader is listening to all our discussion right now, and you yourself are getting the fundamental and macro view. How are you looking at how to trade crude right now? Since last OPEC meet in September till now, it's almost holding on. Right, Viral, this one, the trading strategy which you've been adopting on crude.
Well, as most of the people ahead of me have mentioned, that this is a big event, and right now I think the levels that we are trading between $46 and $48 is more or less like a no trade zone till we get some more clarity with regards to the OPEC production cuts. But if I were to draw a little bit longer term perspective, I think we have constantly been making higher highs on crude oil. I think on MCX we have seen higher lows on crude oil. We have seen levels of 2750, then 2900. And I think, right now the zone between 2900 to 3450 levels on MCX crude is where we see either range breakout happening, and if the production cuts do happen, then I think $51, $52 on the upside, which translates to roughly about $34.50 on MCX prices. We can expect the markets to touch those levels, and if there is further momentum, then possibly a breakout over these levels cannot be ruled out. Whereas on the other side, if the deal does not go through, then I think the markets might touch about $42, which would translate about 2900 or 2850 levels or so, which again would be a good level to start accumulating positions. So, we would position ourselves at either end of the spectrum depending on where the outcome comes.
Vandana, a lot of brokerages globally also have come out notes indicating what to do to their clients in whatever way the meeting actually pans out. What would your view would be? If there is no agreement, how much fall, which a lot of people on the street believe could come in? What are your thoughts? And if they do agree, would that lead to significantly higher levels, at least in the short term?
So a couple of very binary options have already been discussed in the market. And I think there seems to be a broad consensus that if there is an agreement, and herein the expectation is that they are looking to deliver a credible, meaningful cut. If there is such an agreement, then OPEC's aim of putting a floor at $50 would be successful. And I would go along with that view. Whereas if there is no agreement tomorrow, prices, as we've been talking, they're already sitting in mid-40s. Post Algiers, we've seen the euphoria created by the resolution in Algiers saw Brent climb to as high as 53. Now it's sitting at 47, so crude could start slipping very quickly towards 40. I think we've discussed these two options quite a bit. I'd like to just put a third option out there as well, a possibility rather, is that they buy some more time. They kick the can down the road. They say that we are still, as a group, we want to have this agreement, but it will take us more time. Because let's face it, I mean, there's less than 24 hours left, and there's major differences still on some of the countries' individual production quotas. So it's a possibility that they say that let's take some more time, talk these things out, and meet again in a few weeks. That just means, unfortunately, much more uncertainty and volatility for the markets, for a bit longer.
No, you have a fair point. You have a fair point, because the factors which are to be discussed may not be agreed upon this meet, and probably that is the reason. There could be some reason why Russia has changed the stance so dramatically between now and then, and they may want to buy more time. But Abhishek, what are your thoughts? You believe that it may not actually lead to any agreement, because automatically there is a demand supply balance which we are heading towards. In that sense, what is the price range you are working with over the medium term?
Well, like I said, there is still a chance of a deal. I'm not saying that's not going to happen completely. The chance is that at what levels, is there any country there, in such as Saudi Arabia, which is ready to swallow that gap which is currently in place, which is at 200,000, around 200,000, which is being disagreed on in terms of cut, whereby Saudi Arabia is expecting a little bit more scale back from other countries, and that 200, it seems to be in addition to Saudi Arabia's agreed 4.5% cut. I don't know whether Saudi Arabia will be ready to take that. In the absence of a deal, I do believe that you will see prices go down, and now this will be determined basically by how much oil is in excess in the first quarter of next year, which could be, if you're looking at almost 1 to 2 million barrels per day excess, because seasonally demand goes down in first quarter, remember, and if they continue to produce at current levels, we could have up to 2 million barrels excess in the first quarter. That could mean that you could have a significant amount of oil accumulated in first quarter, and do we have enough storage capacity in first quarter? But once we move into second quarter, and as we move along 2017, we anyway go into balanced market, and we anyway start getting support. So that first quarter will be the crunch point. In the absence of a deal, you can see oil prices very easily going below 40, 30 for that matter. We could see the super contango 8 and 9 kind of situation, but for a short period of time. But in the presence of a deal, what you're going to do is you're going to remove that uncertainty. You might still have surplus in first quarter, but just less surplus to test the storage capacity, and hence markets will price it in much earlier and will go up just immediately after the meeting. So for me, it's still not yet decided. You could still have a surprise deal at the end of the day, but equally for the timing, it looks a bit uncertain right now.
Viral, how are you recommending your clients to trade today? How's the trade happening right now on MCX crude? How are the volumes? How's the volatility? And tomorrow, what are you recommending them to do, whichever way pendulum swings?
Well, the problem is that when you have such kind of an event, the markets has a gap up or a gap down opening. In case if the news comes out post the market hours, but otherwise, I think if you look at the overall trend, the market has come off from $51 levels to about 46, and I think on MCX psychologically 3,000 is a good support level for the market, but I would place that support levels below 2,900 or so. So I would just want my clients to be safe for the time being, because there is a lot of uncertainty, and possibly once the announcement comes, then you can take a much more informed position, because after the Brexit and the US elections, such kind of binary events are where clients stand to kind of lose or make money because of the volatility. And here we would just want to take a cautious view, not keeping a lot of positions in the market right now, but play at both the ends. If the market goes to 51 and above that, then possibly initiate some fresh longs, but otherwise the range that we are playing right now is between $42 and $51, so that is what it is.
Hans, between now and next couple of months beyond this meet, depending on the outcome, what are the factors you would watch out for? One of the factors which people have started talking pretty less about is the output from the US shale. That business perhaps not very attractive anymore, so it's not attracting a lot of investments. But what are your thoughts there? And beyond that, what would the key monitorables be?
Yes, well, looking a few months ahead, I think it's clearly think that the market is going towards a balanced situation, and therefore oil prices of towards $60 would be justified. And of course, a deal tomorrow would speed up that process and push prices higher. And if there's no deal, then it can take a bit longer as prices push back towards the low 40s. But especially if oil prices start to pick up again, that would indeed create some more possibilities for U.S. shale. But I'm not sure whether that's big of a risk. I mean, after all, you see a lot of investments in the oil sector being cut back in other countries, non-OPEC, non-shale, and therefore production there is falling under pressure. So a bit more U.S. shale to balance out this market is in fact necessary to prevent a shortage in the market and therefore even much higher oil prices.
Vandana, since you're sitting in Singapore, your observation on another factor may not be particularly timely with the OPEC, but we are observing Singapore refining margins are climbing back to 8-9 month high. What are your thoughts there? And I mean, just a couple of months back, we saw almost $2.5–3. We are back at $8. What's happening?
Yeah, so the refining margins have been good in Singapore. This is, we go into the winter months. We've just come out of a turnaround season, and as we go into the winter months, in areas of China, Japan, Korea, the winter heating demand kicks in, and overall products demand has been generally good. We have seen refining margins quite volatile this year and unpredictable. I think a lot of that has also been influenced by the product exports coming out of China. That remains unpredictable as well. I think going forward, what one can safely say about refining margins are they're probably going to be as unpredictable and volatile as crude prices themselves.
Viral, just one quick word. The volumes on equity side have gone down very sharply, at least in India here, because of what's happening, some of the policies on the demonetization side. It may not be exactly correlated with the OPEC meet, but the volumes in oil or commodity space, has that also been impacted because of demonetization?
Well, I think I'll split that question between the two exchanges. I think overall for the agricultural sector, which obviously has suffered an impact because of the demonetization, we have seen a fall in the volumes at NCDX back close to about 40 to 50% in the preceding, in the days following the demonetization exercise. And they have yet to recover back to their original levels. But I think on MCX, the volatility has been particularly good, especially on the base metals and the energy front. And, with so many events coming up in December, we expect the volatility to be there. And, there we don't see a massive dip in terms of volumes. Obviously, the sentiment is not that great, but I think with more opportunities for participants to take positions in the market, we expect that the year end is going to be strong in terms of volumes on MCX.
All right, gentlemen and the lady, thanks very much for joining us on this special telecast of Commodities First ahead of the crucial OPEC meet. Clearly, consensus coming out from most of our experts is that the chances are evenly split as far as tomorrow's meet is concerned, but the range to watch out for on crude oil for next couple of months could be $41 on the downside and $51 on the upside. Let's see what happens tomorrow. We'll get you live reporting from of the outcome of OPEC meet with more analysts tomorrow. Thanks very much for watching.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.